For nearly 50 years, there has been an unwritten law that every financial investor knows by heart. When interest rates go up, gold must go down. It's the textbook correlation we've all relied on. But take a look at the data on your screen right now. U.S. Treasury yields are sitting at decade highs, yet gold is relentlessly carving out new all-time peaks. This shouldn't be happening. Is this decades-old rule officially dead? Or is the market hiding a truth far more disturbing than a simple price hike? Welcome back. If you've been watching the charts lately, you've probably noticed a massive widening gap. On one side, we have the old guard, the retail investors in the West. They're following the old playbook, selling their gold ETFs because, hey, why hold a non-yielding metal when you can earn 5% sitting in cash, right? But on the other side, something historic is unfolding. While the West sells, the East is buying with an almost desperate conviction. Central banks in China, India, and the Middle East aren't just dipping their toes in, they are absorbing every ounce of physical metal they can get their hands on. They're paying record premiums, ignoring the opportunity cost of high interest rates, and effectively breaking the traditional link between gold and the US dollar. In today's deep dive, we are going to decode this great divergence. We'll look at the data provided by the World Gold Council and ask the question that no one in mainstream media seems to be addressing. Why is gold no longer afraid of interest rates? We're entering a new financial era where the maps we used for 40 years no longer work. If you're still waiting for gold to drop just because the Fed is higher for longer, you might be missing the biggest structural shift in global finance of our lifetime. To understand why the old rules failed, we first need to look at the one math equation that every billionaire on Wall Street uses to value their assets, the real yield. To understand why the old rules are collapsing, we need to go back to the most fundamental calculation used by every Wall Street billionaire, real yield. For decades, if you wanted to predict where gold was going, you only needed to look at one thing, the real yield of the 10-year Treasury. The logic was bulletproof. Gold pays no dividend, it has no coupon. So when real yields, which is simply the interest rate you get after subtracting inflation, go up, gold becomes a liability. Why hold a heavy bar of metal in a vault when Uncle Sam is willing to pay you a guaranteed 2% or 3% in real purchasing power? The formula was the law. Real yield equals nominal yield minus inflation expectation. When that number turned positive and started climbing, gold would historically fall like a stone. It was a perfect mirrored dance, an inverse correlation that defined the careers of thousands of traders. But then something broke. Between 2022 and 2024, the financial world witnessed a glitch in the matrix. According to data from Kitco and the World Gold Council, real yields surged to levels we haven't seen since the Great Financial Crisis. By the old playbook, gold should have been trading at $1,200 or $1,300 an ounce. Traders were lining up to short the market, waiting for the inevitable crash. But the crash never came. Instead, gold didn't just hold its ground, it ignited. We saw a total decoupling. While the paper market in New York was screaming sell because of high rates, the physical market was screaming buy. In early 2024, we saw the 10-year real yield hovering around 2%, a level that usually crushes gold. Yet gold was simultaneously smashing through all-time highs of $2,300, $2,400, and beyond. This is the correlation breakdown. It's the moment the map stopped matching the terrain. If you're sitting there wondering how your portfolio strategy failed, it's because you were playing a game that no longer exists. For 40 years, gold was treated as a tactical anti-dollar trade. When rates were low, you bought it. When rates were high, you sold it. It was simple, it was clean. But today, the market has realized that the interest rate being offered by the government is no longer the risk-free rate, it's a risk-heavy rate. Investors are looking at the math and realizing that a 5% yield doesn't mean much if the underlying currency is being debased to fund an unpayable debt. The take sing or the awakening here is profound. Gold is no longer competing with the interest rate. It is now competing with the credibility of the system itself. Western retail investors, stuck in the old logic, have sold over 300 tons of gold through ETFs in the last year alone, waiting for the traditional drop. Meanwhile, they've handed that gold directly to Eastern central banks and sovereign wealth funds, who are more than happy to take it off their hands. The West is trading a permanent asset for a temporary yield. The East is doing the exact opposite. So if it's not the interest rate driving the bus, what is it? If gold is not scared of a 5% yield, what exactly is it protecting us from?
The answer isn't found in the Fed's dot plot. It's found in a number so large it's almost hard to comprehend. We're talking about the $34 trillion shadow looming over every single dollar in your bank account. To see the real warning sign Joe Cavadino was talking about, we have to look past the price of gold and look at the price of the debt. Because gold isn't just a commodity anymore, it's becoming the ultimate insurance policy against a sovereign default. But if gold isn't afraid of interest rates anymore, what exactly is it terrified of? The answer lies in a number so massive it's beginning to lose all meaning: $34 trillion. That is the current size of the U.S. national debt. For decades, we treated gold like a simple commodity, something you bought when the dollar was weak and sold when the dollar was strong. But that era is over. Today, the market is starting to price gold not as a luxury good, but the ultimate insurance policy against the systemic collapse of the fiat currency regime. Think about this. The U.S. government is currently adding $1 trillion to its debt roughly every 100 days. We are in a fiscal spiral where the interest payments alone on that debt are now costing more than the entire defense budget. This is the warning sign that the mainstream media often ignores. When a nation's debt grows faster than its economy, there are only two ways out: an outright default, which is unthinkable, or inflating the debt away. And this is where gold steps in. Gold isn't just rising, it is re-rating. The smart money, the sovereign wealth funds, and the institutional giants is looking at the math and realizing that the Federal Reserve is trapped. If they keep rates high to fight inflation, the interest on the national debt becomes unpayable. If they cut rates to save the government from bankruptcy, inflation roars back. It's a checkmate scenario for the central banks. When you buy gold today, you aren't betting that the price will go up. You are hedging against the exoia, the erosion of the sovereign debt market. In the past, U.S. Treasuries were the world's safe haven. But how safe is a bond that pays you in a currency being printed by the trillions just to keep the lights on? The suitcase test I mentioned earlier isn't just a fun experiment. It's a reality check on value density. You can't hide $34 trillion of debt. You can't print more gold. And you certainly can't default on a physical asset that you hold in your own custody. This is why we are seeing gold repatriation. Nations like France and others moving their bars out of New York and London and back to their own soil. They aren't doing it for technical management. They're doing it because they understand that in a debt crisis, if you don't physically hold the asset, you don't own it. We are witnessing a structural shift where gold is reclaiming its throne as the non-custodial anchor of the global financial system. It is the only asset that doesn't require someone else's promise to pay. But here's the real twist. While the West is distracted by the daily noise of the Fed's dot plot and employment numbers, a massive pivot is happening behind the scenes. The control of this sovereign insurance is moving. It's moving away from the vaults of Wall Street and into the hands of a new power block in the East. If gold is the insurance, then the East is currently buying up all the policies. To understand how they're doing it and the shadow buying they're using to hide their tracks, we have to look at the Great Eastern Pivot. If gold is the ultimate insurance against the debt crisis I just described, then we need to talk about who's buying up all the policies. Because while Western retail investors are looking at their screens, the East is looking at the vault. Let's look at the numbers. According to the World Gold Council, we are witnessing a massive geographic divorce. Global gold ETFs saw a massive inflow of nearly $7 billion in April alone. But here's the kicker. While Asia saw an increase of nearly $16 billion year to date, North America remains stuck in negative territory. Why is this happening? Why is the Eastern investor, from the People's Bank of China to the average household in Mumbai, buying gold at record highs while the West is selling? It's because for the East, this isn't a tactical trade. It's a strategic necessity. We're talking about de-dollarization, moving from a theoretical headline into a physical reality. For nations like China, gold isn't just a shiny metal, it's a non-custodial asset that cannot be frozen, sanctioned, or canceled by a stroke of a pen in Washington, D.C. After seeing what happened to Russia's reserves, every central bank in the East has realized that if your wealth is just a digital entry in someone else's banking system, you don't really own it. But it's not just central banks.
Look at the shadow buying, or the OTC market. There is a massive transparency gap between what China officially reports and the actual trade flows moving through hubs like Hong Kong and Switzerland. Data from the Swiss Customs Administration shows that over 50% of their exports of gold are now heading straight to China and India. The East is effectively draining the pool of available physical gold. They are accepting the physical premium, paying more than the spot price just to ensure they have the bars in their own hands. In India, despite customs bottlenecks, the demand for gold bars and coins has surged by over 50%. They aren't waiting for a dip, they are buying the re-rating. This is the great pivot. We are moving from a world where gold was priced in London and New York based on paper contracts to a world where gold is priced in Shanghai based on physical delivery. When Joe Cavatone talks about market plumbing, he's talking about this shift. The East is building its own infrastructure. They are creating a system where gold, not the dollar, acts as the central clearing hub for trade. Whether it's oil, semiconductors, or consumer goods, gold is returning to its role as the neutral settlement currency. Think about the irony here. Western investors are selling their paper gold to earn a 5% yield in a currency that is losing its global dominance. Meanwhile, Eastern nations are taking that physical gold and using it to build a new parallel financial system that doesn't rely on Western debt. This is the deepest level of the warning sign. The West is losing control of the marginal ounce. And once the price discovery shifts entirely to the East, the Western investor will find themselves in a very difficult position, trying to buy back the insurance policy they sold, but at a price that reflects the new reality of a multipolar world. So we've seen the breakdown of the old rules, we've seen the looming shadow of the $34 trillion debt, and we've seen the massive migration of physical wealth to the East. What does this mean for your portfolio? If the maps have truly changed, what is the final trigger that will force the West to wake up and start chasing the price? That brings us to the final warning sign, hidden in the liquidity of the system itself. We have to face the music. The financial world of the 1980s and 90s is officially in the rearview mirror. The old operating system, the one where gold was just a puppet of the Federal Reserve's interest rate hikes, has crashed. We've seen the evidence. We've watched the correlation between gold and real yields snap in real time. We've looked at the staggering $34 trillion mountain of debt that is forcing the world to find a new safe haven. And most importantly, we've witnessed the greatest migration of physical wealth in modern history as gold moves from the paper-heavy West to the physical-driven East. Gold hasn't just gone up in price, it has changed its fundamental role in your portfolio. It is no longer a tactical speculation. It is becoming the ultimate insurance policy against a sovereign fiscal crisis. The Eind warning sign Joe Cavatone and the World Gold Council are pointing to isn't about a temporary dip or a technical correction. It's about a structural reset. When the institutions that print the money start buying the gold, they are telling you everything you need to know about the future of that money. So, here is the question you need to answer for yourself tonight. If real yields are no longer the enemy of gold, then what is the ceiling? Where does this rally end when the West finally realizes it has sold its insurance just as the storm is hitting the coast? Will you choose to hold the debt of a system that is printing its way to survival? Or will you choose the one asset that no government can print, no bank can freeze, and no central power can devalue? The map has changed. Don't be the investor who gets lost using an old one. What do you think is the true breaking point for this market? Are we headed for a total monetary reset? Or is there a move the Fed has left that we haven't seen yet? Let me know your thoughts in the comments below. I read every single one. And if this deep dive helped you see the market a bit more clearly, hit that like button and subscribe. Let's navigate this new era together. I'll see you in the next one.